In this video, I break down 10 essential strategies that will help you build lasting wealth and secure your financial future. Number 1, start investing early. The secret to successful investing is starting early. For example, if you invest $200 a month from age 25 to 35, you could end up with about $300,000 by age 65. But if you wait until age 35 to start investing that same amount, you'd have around $245,000 by age 65. The earlier you start, the more time your money has to grow, thanks to compounding. Even small investments made regularly can add up significantly over time. Number 2, smart allocation and consistency lead to success. Think of long-term investing as a recipe with 3 key ingredients: time, asset allocation, and monthly investments. Time is crucial, but it works best with the right asset mix and consistent investing. Success comes from balanced asset allocation and regular monthly contributions. Your portfolio should reflect your goals, risk tolerance, and time horizon. For example, if you want long-term growth, you might favor stocks, while a conservative investor might prefer bonds. By investing a fixed amount each month, also called dollar cost averaging, you end up buying more shares when prices are low and boosting long-term growth. This approach takes advantage of market dips and ensures steady, disciplined growth over time. Number 3, evaluate your risk profile. Understanding your risk profile is crucial but can be tricky. Often, the best way to gauge your risk tolerance is through experience. For example, if a 5% dip in your portfolio makes you lose sleep, you are likely a conservative investor. It's important you see how risk relates to long-term returns and achieving your financial goals. Some early savers invest too conservatively, not realizing that while stocks are volatile in the short term, a diversified equity portfolio generally yields higher long-term results. Your risk profile will change throughout your life. So if you are nearing retirement, you shouldn't have the same risk profile as when you were in your 20s and 30s. Number 4, automate your investment contributions. To boost consistency in your long-term investing strategy, automate your contributions. With a monthly investment plan, you can automate yourself to become a millionaire over time. You can achieve this by having money deducted automatically from your paycheck for retirement. Saving for retirement can be challenging, but by contributing a small percentage of each paycheck to a 401k or other investment plan, you can build substantial wealth over time. You can also automate investments in other brokerage accounts. Many firms allow you to set up an investment schedule and transfer funds from a linked bank account to your portfolio. Number 5, the power of diversification. You've probably heard the real estate mantra, location, location, location. Well, for savvy long-term investors, the secret is diversification. Growing an investment portfolio hinges on 2 main strategies: selecting long-term investments and minimizing losses through effective diversification. This requires looking beyond traditional assets. Historically, stocks and bonds have been the primary options for diversification, but their simultaneous decline in 2022 highlights a need for broader consideration. True portfolio diversification requires 3 key components: equities, fixed income, and alternative investments. Incorporating asset classes such as private real estate, private credit, and private equity can reduce portfolio volatility and improve long-term returns. Additionally, geographical diversification mitigates home country bias and shields your portfolio from the impacts of domestic recession. Number 6, keep emotions out of investing. Emotions are a natural part of being human, but they have no place in your investment decisions. For long-term investors, the real enemy isn't market volatility. Short-term fluctuations are irrelevant. The real threat is the temptation to frequently buy and sell. Long-term investing demands you adhere to your strategy, regardless of your views on the economy, fiscal policy, or politics. Instead of attempting to predict market fluctuations, it's more effective to invest consistently over time. Historically, market trend upwards over the long run. To benefit from this growth, you must stay invested even during tough times, as they are often followed by periods of significant recovery. Number 7, consider a Roth IRA. A Roth IRA is an excellent option for long-term investing, as it grows tax-free throughout your lifetime. With a Roth IRA, you contribute after-tax dollars, allowing you to withdraw money tax-free in retirement. It's one of the few investments that Uncle Sam won't tax, unless you withdraw early, which could incur taxes and penalties. Roth IRAs also don't require minimum contributions, unlike traditional retirement accounts, which mandate withdrawals starting at age 73. This feature allows your Roth IRA to grow even longer. However, not everyone is eligible for a Roth IRA. The IRS set income limits on who can contribute and how much they can save. In 2024, the income phase-out range begins at $146,000 for single filers and $230,000 for married filers. Number 8, keep taxes in mind. Taxes are often the greatest expense Americans face. That's why it's crucial you have a tax-intelligent financial plan optimized to achieve your goals and minimize your tax burden. Taxes can be one of the largest expenses you face, making it essential to have a tax-efficient financial plan that aligns with your goals and reduces your tax burden. So how can you create such a plan? The easiest way is by working with a tax-savvy financial advisor. Selecting the right one can significantly influence your future. Alternatively, you can do it yourself by focusing on asset location. This means placing your highest tax investment in tax-sheltered accounts and your tax-free investment in taxable accounts. You want to have a mix of taxable, tax-deferred, and tax-free investments to draw from in retirement to ensure a flexible and efficient tax strategy. Number 9, minimize costs with index funds and ETFs. Taxes aren't the only expense eaten into your long-term investment returns. Fees can be another hidden burden. For example, a $100,000 investment earning 7% annually could grow to over $575,000 in 25 years without fees. However, with just a 2% annual fee, it will be worth less than $350,000. To keep costs low, invest in low-cost index funds or ETFs that track broad market indexes like the S&P 500. This strategy offers immediate diversification and generally outperforms most actively managed funds after fees in the long run. Number 10, reject get-rich-quick schemes. One long-term investing strategy to avoid is the get-rich-quick scheme. Anything that promises to make you a millionaire overnight or guarantees automatical returns is best left for the casino. These investments are often highly volatile and frequently riddled with scams and fraud. For reliable long-term investing, stick to the time-tested methods mentioned above. By following these strategies, you'll be well on your way to achieving your financial goals. I'd love to hear your take on my 10 strategies. So take a moment, comment and share your thoughts. And if you found this information helpful, like, share and subscribe to the channel. Until next time, stay financially savvy. We'll see you in the next video.